What's up, everybody? The channel went up a little over 200 subscribers since my last episode covering Nikola and Tesla stocks. So for anyone that's new, welcome to Mr. Zero to Infinity for episode 45. It looks like a lot of investors are on the same mission of growing their stock portfolios from zero to infinity. Thanks for all the support. If you're looking to grow your portfolio as high as possible, then click that like button and maybe subscribe while you're at it. In this episode, I'll be going over 3 cheap dividend stocks to buy in June 2020, and then I'll end with a quick stock portfolio update as I do in every episode. Before I get started, remember that all my episodes are for entertainment purposes only. I'm not a financial advisor. My thoughts, opinions, and commentary of finding the latest trends to build wealth in the stock market will not meet your own unique goals. For that reason, always do your own research and due diligence and never rely on any of my information in any of my videos. So let's dive into this one, 3 cheap dividend stocks to invest in 2020. This list will include 3 stocks that I intend to eventually buy now in June 2020. First, let's break down the word cheap. The definition of cheap may be different for you, but when I think of the word cheap, I think of stocks that are undervalued today and will be higher in price over a long period of time, 5, 10, 15, 25 plus years. I'm a long-term investor, so I have plenty of time to wait it out for my cheap stocks to grow in value. For me, cheap doesn't mean stocks under $5 or stocks under 10, because nowadays many online brokerages like Robinhood and Fidelity offer fractional shares. So right now, you could be a part owner of Berkshire Hathaway Class A shares, which are trading over $200,000 per share at this time. Sure, you may only own 0.00001%, but you can indeed buy any stocks that may appear expensive when looking at just the stock price. I never limit my options when looking to invest in stocks. For me, there's no difference if a stock is trading at $10 or over $1,000 per share, since the real metric I look at is market cap. I've discussed market cap in previous episodes. So my first dividend stock is Apple stock. Apple paid me a dividend back in May 2020. At that time, for every share of Apple stock I owned, I received 82 cents. That's 82 cents that goes straight to my cash position in my stock portfolio, since I don't use the automatically reinvest feature. The main reason I don't automatically reinvest my dividends is because I prefer to have control over the price of any new shares I buy for the stock portfolio. Since the stock market is constantly going up and down, I like to buy stocks when they are going down, as long as my bull thesis is still intact. Apple, in my opinion, is a growth stock that happens to pay out a dividend each quarter. When a company has a healthy balance sheet, it is capable of paying out a quarterly or even a monthly dividend to all of its shareholders. My goal for my Apple stock position is to continue to buy more and more Apple shares so my dividend payments get bigger and bigger as time goes by. Apple is a company that I've discussed in detail over the past 44 episodes. It's a company that will have an opportunity to be one of the best 5G stocks in 2020 that also pays a dividend. Warren Buffett is a large shareholder for a reason. Apple products are very popular all over the world, and that's why it fits my investment strategy of finding growth stocks that will continue to go up in value for a long time. I'm not worried about Apple having a market cap of over $1 trillion. For me, Apple is a safe stock that will be around for decades. My second cheap dividend stock that I plan on buying in 2020 is Starbucks, ticker SBUX. Yes, another growth stock that I currently own in my stock portfolio. It's quite entertaining to see other channels constantly pump out a list of 5 or 10 best stocks each month. The difference with my channel is that I actually document my stock portfolio and buy the shares of stock that I discuss. There's no need for me to research hundreds of stocks on a regular basis. That's just too much work for one individual like me. I invest in companies that I understand. I understand the Starbucks brand and the growth potential outside of the United States. Starbucks is a global brand which is very similar to Apple. Starbucks paid me 41 cents per share back in May 2020. Once again, my goal is to build up my Starbucks stock position higher and higher so my dividend payout each quarter grows bigger and bigger. Just remember, Starbucks isn't as big as Apple when it comes to the market cap. I'll be monitoring Starbucks financials closely since dividend payouts are never guaranteed. Many dividend stocks had to cut their dividends since they ran into solvency issues. Long story short, if you own a stock that doesn't bring in revenue, then there's no cash to pay out a dividend. Think about it. Many dividend stocks hit a roadblock with the closures and shutdowns these past couple of weeks, so it's important to review earnings calls and announcements to make sure the management team is on top of the numbers at all times. Starbucks pays out a larger dividend yield compared to Apple stock at this time, so that's always a plus. Every time I see someone carrying a Starbucks cup of coffee, I know that those revenues will eventually hit my portfolio's cash position as a dividend payment, even if we're talking about cents per share. That 41-cent dividend payment per share was 41 cents I didn't earn prior to buying my Starbucks position. On to number 3. This cheap dividend stock has to be a new one since I've covered the only 2 stocks that are in the public portfolio that pay a dividend at this time. Before we discuss my 3rd dividend stock pick, let's do a quick stock portfolio update. The portfolio is a little over $6,700 at this time. I took this screenshot. We sure are moving along, looking back when the stock portfolio started at $0 at the beginning of the year of 2020. You'll notice I bought 1 new share of Fiverr International, ticker FVRR, which actually raised my cost basis a bit higher to $28.10. Raising my cost basis is okay with me since the position is only around $2,500. With time, I plan on having all of my positions over $10,000. Remember, I'm just getting started and I'm in no rush to grow the portfolio. Fiverr hit an all-time high over $70 per share last week, so a pullback was expected, and I'll continue to monitor the support levels when I buy more stock. Right now, a lot of investors are pulling out of the stay-at-home stocks and they're entering other industries. Nikola NKLA stock went up last week, and even Luckin Coffee LK was flying up. The stock market is always changing, so make sure to be careful with the speculative stocks that don't have healthy balance sheets. I'm seeing a trend of traders acting like gamblers at this time, thinking the stock market is easy to make a ton of money. Lots of new investors are up over triple-digit returns in just a couple of weeks, so be careful out there. Returns will eventually average out as years tick by. With the big days, there will always be the down days, so make sure you know your risk tolerance. A stock that is up over 100% in a day or 2 can easily be down 100% the next trading day, especially if the market begins to fall in 2020. Looking at my portfolio, you'll notice Penn stock surpassed my Apple stock holding as my 2nd largest company. Starbucks and Square are my 2 smallest stock positions at this time. If you've been following along my journey of growing this stock portfolio, you know that I like to lower my cost basis in all my stocks whenever I get the chance. For me, the lower the cost basis I can get, the better, since the stock portfolio is still very small at this time. The stock market has been going up over the past couple of weeks, which has allowed my gains to increase the portfolio each episode. I'm looking to add more cash and buy more stocks as we continue with the episode series, so I'll be ready if the stock market crashes again. So back to my 3rd cheap dividend stock that I feel is undervalued in June 2020. In the past, I've discussed Walmart stock, which has been on my research board for quite some time. Another dividend stock that has been high up on my list is COSTCO, ticker COST, is my 3rd cheap dividend stock, mainly because of the brand and ecosystem that it has built over the years. When people need items in bulk, COSTCO is one of the top options for great value. The COSTCO loyal shopper base has been growing and matches up with my growth stock strategy of stocks that I plan to hold for many years. Plus, it pays a quarterly dividend. COSTCO paid a quarterly dividend of 70 cents per share. There will always be demand for food and household supplies. If the stock market crashes again, I would like to build a position in COSTCO. I like the fact that COSTCO has a subscription business model, which is basically a recurring revenue stream that helps with future growth. So there you have it, Apple stock, Starbucks stock, and COSTCO stock. I'm interested to see how the stock market reacts over the next few weeks and months. What's next after this V-shaped recovery? Time will tell. Let's end it there. Play the music. Maybe I didn't earn your subscription with this episode, but there's always next episode. It's free to subscribe, and a couple of my favorite comments from last episode are on your screen. Feel free to watch my earlier episodes. For anyone new, all my episodes are meant to be watched in order since the stock market is always changing and there are always new trends to be found as the weeks tick forward. Instagram is Mr. Zero to Infinity. Thanks again for watching. Let's keep building from zero to infinity. You got this. As always, this episode is not intended as investment advice. Do your own research prior to making any investments and do your own fact checking. Read the disclaimer on your screen fully. Remember, all opinions in this episode are mine and mine alone. I'm not a financial advisor, and this video is for entertainment purposes only. Never rely on any of my information when making investment decisions. Peace.